In the gold market, there are numbers that feel big, and then there are numbers that feel like a warning flare. In 2025, total gold demand topped 5,000 tons, and the estimated value of that demand reached about $555 billion. That is not a hobby market. That is a global balance sheet speaking out loud. And what made it stranger is how fast the story changed. Not months, not weeks. In 48 hours, a quiet policy detail, a price spread, and a set of institutional signals lined up in a way that usually only happens when something is already in motion behind closed doors. Because they said this could never happen in modern markets. They said physical and paper would always stay tethered. They said liquidity would smooth everything out. They said gold was old money, a relic, a sideshow. But the data tells a different story. Institutions already know what the next phase looks like, and most people only notice after the chart has already printed the move. So let me show you what the market actually reveals, because what I'm about to lay out is not opinion, it is pattern. And it is a pattern China keeps repeating. There's a simple three-step endgame strategy that shows up again and again across different cycles, different headlines, and different levels of stress. Step 1 is control the gates of physical flow. Step 2 is let the spread do the messaging. Step 3 is normalize the rules only after the metal is where it needs to be. If that sounds abstract, good. Because the trick is that it usually hides inside boring administrative language, not dramatic press conferences. It hides in permits, quotas, settlement rules, and the quiet machinery that decides where real metal can go. Welcome to Vault Line, where we decode what matters before it becomes headlines. If you like analysis that treats markets like a system, not a meme, you're in the right place. And if you've been listening to that wise elder in your life who always says, watch what they do, not what they say, consider subscribing. Drop a comment with where you're watching from. Because this story looks different depending on where you sit in the world. Now, here's the event that pulled the curtain back. On January 6, 2026, reports circulated that China's central bank moved to streamline gold import administration, including extending certain multi-use permits to 9 months from 6. On the surface, that sounds like paperwork. But in a market where physical supply is the point, changing the tempo of import permissions changes the rhythm of the entire domestic supply chain. Think about it this way. If you can only open the valve for a short window, you force demand to compete in bursts. If you widen that window, you can smooth buying, improve logistics, and reduce the risk that domestic premiums explode when the market is stressed. It is not a neutral change. It is a lever. And the abnormality wasn't just the rule tweak, 3 tons of gold in 2025. That's not a retail stampede. That is official sector accumulation, and it's happening in a climate where trust in paper promises has been quietly eroding. So the mystery becomes this: why adjust the plumbing now, after years of tight management, unless the next phase requires more reliable physical inflow? To answer that, you have to zoom out and look at the hidden pattern. In 2008, the global system cracked under leverage. Liquidity evaporated and trust became scarce. Gold didn't just rise, it became a refuge for balance sheets. In the years that followed, the message was simple. When the banking system is questioned, gold becomes a credibility asset. In 2013, we saw another version of the playbook. Western paper markets moved violently, sentiment flipped, and physical demand in Asia surged. That year is remembered for price action, but the deeper signal was the migration of metal. When price drops collided with physical buying, the system revealed that cheap in paper terms can mean scarce in physical terms. In 2020, crisis went global again. Policy responses became enormous, and the idea of infinite liquidity became a slogan. Gold responded, not because of fear headlines, but because monetary reality was changing. When governments and central banks expand balance sheets at speed, the market looks for anchors that are not someone else's liability. Now in 2025 and into early 2026, the pattern shows up again, but this time the evidence is not just in price, it's in structure. Demand exceeds 5,000 tons in a single year. 3 tons, 5 tons. Those numbers matter because they sit on top of an even more important variable: control. China does not treat gold like a free-floating commodity. It treats gold like a strategic resource that interacts with currency stability, capital flows, and domestic confidence. That is why the 3-step playbook makes sense. It's not about predicting tomorrow's price. It's about managing what gold represents inside a system. So who is positioning, and how can you see it? First, look at the official sector. When central banks buy hundreds of tons, they are doing something that private investors can't replicate in scale. They are changing the composition of national reserves. They are converting foreign claims into metal. They are diversifying away from reliance on another country's policy decisions. Second, look at the domestic machinery. Import rules are not random. In many countries, if demand rises, imports rise, and the market clears. In China, imports are managed. That creates an environment where the spread between domestic and international prices becomes a signal. The spread becomes a pressure gauge. Third, look at the narrative contradictions. When the public conversation calls gold barbarous relic while official institutions continue accumulating, you have a mismatch between story and action. And when story and action diverge, the action usually wins. Here's where it gets interesting. The dislocation is not subtle when you know where to look. One market can trade gold as a leveraged financial contract, where most transactions never touch metal. Another market treats gold as a physical good, where delivery, premiums, and logistics determine what people are willing to pay. When those two approaches collide, you get spreads that tell you something the headline price hides. And that gap cannot persist indefinitely because either physical flow increases to close it, or the global price adjusts to reflect the scarcity the premium is shouting about. This is the part no one is discussing. Policy changes that seem minor can be the trigger that allows the system to resolve that gap on strategic terms. Extending permits from 6 months to 9 months sounds like a clerical upgrade. In practice, it can reduce friction, improve planning, and allow importers to respond more efficiently when demand spikes. It can also support a controlled increase in physical inflows without announcing a dramatic policy shift. Now let's connect the dots between institutions, timing, and the 3 steps. Step 1 is control the gates. If you control who can import, when they can import, and how long permissions last, you control the pace at which physical supply can respond to domestic demand. That means you can prevent sudden outflows of currency, manage domestic liquidity, and stabilize confidence when markets wobble. Step 2 is let the spread do the messaging. If domestic demand rises while the gate stays tight, the premium widens. That premium becomes a signal to domestic savers, to jewelry demand, to industrial users, and to institutions. It also becomes a signal to the world that physical demand is stronger than paper pricing suggests. Step 3 is normalize after positioning. Once enough metal has been accumulated, once domestic distribution is prepared, once the system is ready, then you can ease the gates. You can streamline permits. You can make the process look more efficient. And because it happens after the positioning, it looks like a response to the market rather than the driver of it. This is not about conspiracy. It's about incentives and tools. Every major financial system uses tools to manage stability. Some do it with interest rates. Some do it with capital controls. Some do it with reserve requirements. In the physical gold market, import administration is a tool. And the evidence is in the numbers we can see. Start with the demand regime. Over 5,000 tons of total demand in 2025 is not a normal year. It signals that gold is being used broadly, as investment, as reserve, as jewelry, as security. The dollar value, roughly $555 billion, puts it in the same psychological category as massive sovereign flows. It becomes systemic. 3 tons in 2025. Even if that number is down from the year before, it remains historically high. And central banks are not momentum traders. They are slow, strategic, and often early. They buy when they want an asset that does not depend on someone else's promise. 5 tons. Whether one believes it is complete or conservative, the reported number alone is large enough to matter. It means gold is not an afterthought. It is a pillar. So what does it mean when the same system that has managed gold inflows for years decides to streamline the process in early 2026? It means the next phase requires smoother access to physical metal. It means they want flexibility, and flexibility is valuable when volatility rises. Now, how is this executed mechanically? Imagine a city with a single bridge that trucks must cross to bring in critical supplies. The city government can't conjure supplies from nowhere, but it can control the bridge. It can set tolls, issue permits, restrict hours, and decide which trucks get priority. If panic buying starts, the bridge becomes the choke point. Gold imports function like that bridge. When permissions are short and quotas are tight, supply arrives in controlled waves. When permissions are extended, the waves can become steadier. The system can reduce spikes in premiums, and it can reduce the risk of shortages that cause public anxiety. Now layer on the global paper market. Paper gold can expand rapidly. Contracts can be created. Liquidity can surge. Price can move without metal moving. That is efficient until the moment someone wants delivery, or until the physical market refuses to accept paper pricing. When physical stress rises, the premium appears. It's like the city market charging more for water because the bridge is restricted. The official price might say water is cheap, but the shelves say otherwise. So the mechanism is a chain. Tight gate plus rising demand equals premium. Premium plus public attention equals pressure. Pressure plus strategic goals equals policy adjustments. Policy adjustments plus institutional buying equals metal migration. And this is where the forward analysis becomes clear, because historically this sequence has led to the same kinds of outcomes. If the spread between physical and paper remains elevated, the system has to resolve it. Historically, resolution happens in one of 3 ways. The conservative scenario is that the gate is open just enough to smooth supply, premiums fall, and the global price remains stable while physical flows increase quietly. In this scenario, the story stays boring, and that is exactly why it works. The moderate scenario is that premiums persist and begin to pull global pricing higher because arbitrage pressures increase and inventories tighten. In this scenario, the headline price begins to reflect what the physical market has been whispering. The aggressive scenario is that physical stress becomes visible to a broader audience. Delivery concerns rise, paper liquidity gets questioned, and price adjusts abruptly to restore confidence. In this scenario, the move is not purely about demand, it is about trust. Notice what none of these require. None require a prediction that gold must do anything. They simply describe what has happened when the same structural conditions have appeared in the past. So what should be watched? Watch the policy plumbing. When administrative rules around imports and settlement get eased or tightened, that is the system adjusting the gate. Watch the spread between domestic physical markets and international benchmarks. When a premium appears and persists, it is a sign that physical demand is stronger than paper price implies. Watch official sector behavior. Central banks buying hundreds of tons is the slowest, clearest signal that trust is being repositioned. And watch the narrative. When commentary insists gold is irrelevant while institutions keep accumulating, that contradiction is telling you where the real priorities are. Now, let's return to the three-step strategy and make it undeniable by tying it to the repeating logic. China's approach to gold makes sense when you view it as a component of long-term monetary resilience. Step 1 is always about control, because control over flow prevents chaos. Step 2 is always about signaling, because spreads and premiums communicate scarcity without speeches. Step 3 is always about normalization, because once positioning is complete, the system can afford to look relaxed. This is why a change like extending permits from 6 months to 9 is not just an efficiency tweak. It is the kind of change that shows up when the system expects the next chapter to involve more physical flow, more demand pressure, or both. And it also explains why so many observers miss it. They look at the headline price and assume the story is finished. But the story is in the mechanics, not the quote. The divide, as always, is between those who track structure and those who track noise. It's not about being smarter. It's about noticing what actually moves the system. Institutions move first because they have mandates, access, and long-time horizons. Retail tends to move last because retail waits for certainty, and certainty only appears after the move has already happened. Information gap becomes a wealth gap, not because anyone is hiding secret charts, but because most people are trained to watch the wrong signals. They watch sound bites, they ignore permits, they ignore spreads, they ignore official sector accumulation because it doesn't trend on social media. But the market rewards attention to the plumbing. 3 tons, and when you notice China adjusting import administration on January 6, 2026, you are not looking at isolated facts. You are looking at a repeating sequence. And the question isn't whether the system will continue to use these levers. The question is whether you will recognize the levers before the price action forces everyone else to notice. This is Vault Line, where we decode what matters before it becomes headlines. If this connected dots you hadn't seen lined up this way, you know what to do. Because the market rarely announces the shift with a siren. It signals first quietly through structure. And in gold, structure is the story. The price flashes on a screen. The infrastructure is the network of exchanges, vaults, banks, refiners, shipping lanes, and rules that decide what counts as deliverable metal and who can access it. When infrastructure tightens, the screen can look calm while stress builds underneath. In the West, most exposure is paper-wrapped, futures, unallocated accounts, and exchange-traded products designed for speed. In China, gold is treated more like inventory, bars, kilograms, refining capacity, and physical settlement culture. 2 philosophies, 1 headline price. When those philosophies collide, you get the key dislocation. The world can be long gold on paper while still competing for specific bars in specific locations. That's why a physical premium can appear even when the headline price looks steady. It isn't a mystery, it's the market mapping scarcity. This is also why experts disagree. Some point to a slower pace of official buying and declare the trade over. Others point to high prices and assume demand must fade. But the system doesn't move on one variable. It moves on the interaction of demand, flow restrictions, and trust. Central banks buy gold for a simple reason. It carries no counterparty risk. A bond is a promise. A reserve deposit is a promise. A swap line is a promise. A bar is an object. When confidence in promises gets questioned, objects gain importance. That's the context for the repeating historical shape. In 1971, the monetary rules changed and gold shifted from an official anchor to a free price. In 2008, leverage broke trust and gold regained status as a credibility asset. In 2013, violent paper moves collided with intense Asian physical buying, revealing that cheap on a screen can mean scarce in a vault. In 2020, balance sheets expanded at speed, and gold responded as systems searched for an anchor that wasn't someone else's liability. Different cycles, same underlying physics. Now zoom in on the players. On the Chinese side, the central bank sets tone, but the system includes regulators, state-linked banks, importers, and a domestic exchange ecosystem that routes metal to wholesalers, jewelers, and institutions. When import administration changes, it's rarely random because it affects the whole chain. On the global side, price discovery leans heavily on large futures venues and major over-the-counter dealing networks. Bullion banks intermediate between miners, refiners, central banks, and investors. Vault operators handle the physical constraints. Investor vehicles translate appetite into demand for allocated metal or into claims that can be satisfied without metal. The system is flexible right up until physical reality becomes the constraint. That physical reality is the asymmetry that makes gold unique in stress. Paper exposure can expand quickly. Physical supply cannot. A contract can be created. A bar cannot be created on demand. A claim can be multiplied. A bar can only be delivered once. When pressure rises, the premium is the rationing mechanism. This is where China's three-step strategy fits perfectly without requiring drama. Step 1, control the gates, manage who can import, when they can import, and how long permissions last, and you control the pace at which domestic supply can respond. That helps manage currency outflows, liquidity conditions, and public confidence. Step 2, let the spread speak. If domestic demand rises while the gate is tight, the premium widens. The premium becomes a pressure gauge. It signals scarcity and urgency without any official announcement. Step 3, normalize after positioning. Once enough metal is where it needs to be and the distribution chain is ready, the rules can be eased. Streamline permits, reduce friction, make it look like efficiency. The timing matters because the normalization often happens after the strategic objective is already partially achieved. That's why a change like extending permits from 6 months to 9 months can matter more than it sounds like it should. It reduces logistical friction, smooths inflow planning, and lowers the risk of sharp domestic shortages that draw attention. It can also allow controlled increases in physical supply without triggering the kind of headline that invites speculation. So what does the pattern suggest next without turning it into prediction? If physical premiums keep appearing and policy keeps adjusting the plumbing, the market is telling you physical signals are rising in importance relative to paper sentiment. Historically, when that persists, the system resolves it in one of 3 ways. Quiet increases in physical flow that calm the premium, gradual repricing that pulls the global benchmark toward physical reality, or abrupt repricing when trust in paper settlement gets tested. The practical indicators are straightforward. Watch for additional administrative tweaks that open or tighten the gate. Watch whether physical premiums become persistent rather than episodic. Watch for moments when paper markets dip while physical demand absorbs the move without hesitation. Those are the moments when structure, not narrative, is doing the talking. Because Endgame rarely arrives as one dramatic day. It arrives as a sequence of small levers being pulled, spread signals being allowed to form, and rules being relaxed only after positioning is underway. Slowly, then quickly. There's also a perception layer. Sudden, visible shortages can shake domestic confidence, and explosive premiums can turn a technical supply issue into a public signal. Managed flow can dampen that. In that sense, gold policy acts like a stability tool, not to eliminate scarcity, but to control how scarcity is experienced. And when stability is the priority, the preferred adjustments are the ones that read like administration, not emergency, even if they function like a lever. That difference keeps attention low while the system moves metal deliberately.